Welcome to this quarterly market and economic update. As we begin the second half of the year, we'll talk about 5 key themes that investors should be aware of. Through the first 2 quarters of the year, the S&P 500 has gained about 15% as tech stocks and the possibility of Fed rate cuts have propelled the market to new all-time highs. Improving inflation is also slowly beginning to support the bond market and sets up the possibility that the Fed could cut rates 1 or 2 times later this year. However, many investors are still nervous about the market outlook and are waiting on the sidelines, holding on to cash. Perhaps the biggest event in the second half of the year will be the upcoming presidential election, especially the impact that it may have on taxes, inflation, regulatory policy, trade, and more. Over the next few minutes, we'll touch on these themes and discuss their importance for investors to maintain perspective over the next several months. First, the market has experienced a strong rally this year, with the S&P 500 reaching over 30 new all-time highs. Continued optimism over tech and AI-related stocks has helped to drive this rally. This may come as a surprise to some investors since there continues to be significant market and economic uncertainty. Some investors may worry that the market hitting new highs could be a sign that the market is due for a pullback. However, since the market tends to rise over time, it naturally hits many new all-time highs. Investors who worry too much about the exact level and try to time the market may miss out on long-term performance. History has shown us that it's often better to stay invested and focus on the longer-term trends rather than day-to-day headlines. Second, the Fed is expected to start cutting policy rates later this year. These expectations have changed significantly, with the timing of the first rate cut pushed back after repeatedly higher than expected inflation readings. But the most recent data shows that inflation is finally easing. Most recently, both the Consumer Price Index and the Fed's preferred measure of inflation, the PCE Price Index, showed that prices were flat over the month of May. This chart shows the current level of the federal funds rate alongside the Fed's rate projections for the coming years. Their latest projections suggest that there will be 1 rate cut this year, while markets anticipate between 1 and 2. While it's difficult to say, history suggests that a decline in interest rates alongside falling inflation and a strong economy could help to support the market rally that has occurred in the first 2 quarters of the year. Third, this chart shows how bond market sectors have performed each year since 2008. Each column represents a different year, with bond market sectors ordered from best performing at the top to worst performing at the bottom. On the right, you can see that the Bloomberg U.S. Aggregate Bond Index is now flat on the year after struggling through April due to worse than expected inflation in the first few months of 2024, which pushed bond prices lower. Improving inflation doesn't necessarily mean prices will fall for all goods and services, but it does show that we are returning to a more normal environment, a good sign for markets and a harbinger of Fed rate cuts. Since lower interest rates boost bond prices, this has led to improvements in many parts of the bond market, such as investment grade and high yield bonds. Next, generating income from safe investments was a major challenge for investors from the 2008 financial crisis until only recently. This is why many investors are taking advantage of higher cash yields today. However, there are 2 challenges with this. First, many cash yields are still not outpacing inflation. This means that while investors are receiving interest income, the purchasing power of their cash is still being eroded. Cash on its own cannot make up for inflation, which is why stocks and bonds are needed for long-term portfolio growth. Second, the amount of cash that investors hold has increased dramatically. This may be related to fear around markets being at all-time highs. The challenge with waiting until interest rates decline to get back into the market is that both stocks and bonds tend to rally quickly when this occurs, making the timing incredibly tricky. This is yet another reason that it's often simply best to stay invested and diversified. Finally, some investors may be worried about the approaching presidential election, wondering what it could mean for the country and their portfolios. While elections are incredibly important as taxpayers, citizens, and voters, the impact on markets can be counterintuitive. When it comes down to it, financial markets have performed well across both parties over the past century, as shown in this chart. This is because the business cycle and the many factors that drive economic growth are far more important than who happens to be in the White House. This is not to say that policies don't matter, but that changes tend to be incremental and take time to impact businesses and consumers. This chart shows that from an investment perspective, it's important not to overreact to the outcomes of an election or poll results when it comes to our portfolios. So, amidst market all-time highs, slowing inflation, and the possibility of lower interest rates on the horizon, it's important for investors to stay focused and stick to their long-term financial plans. We hope you found these insights helpful. If you do have specific financial concerns ahead of the election and throughout the second half of the year, please don't hesitate to reach out. We look forward to speaking with you.